Welcome back to another analysis video. USIO Inc., ticker symbol USIO, is a small company in terms of revenue that provides integrated payment processing services to merchants and businesses. In other words, this company competes with Visa, MasterCard, PayPal, and others in the payment processing industry. And I want to buy 750 shares for $1.61 per share because I like the following things about this company. The number of their customers has been growing every year since 2017, and this big jump in 2020 is the new customers when they acquired another payment processing company in December of 2020. We will see a similar increase in the outstanding shares graph in the same period due to this acquisition. The revenue has been increasing every year since 2017, which is a good sign because it means that they are doing a good job retaining their customers and acquiring more. The free cash flow in the first 9 months of 2023 is positive and higher than all of the previous years. But of course, we don't know what's going to happen in the fourth quarter of 2023, so there is no guarantee that the free cash flow of the full year of 2023 will be that high. The debt is less than 1% of total assets, which is a great thing because we don't have to worry about the interest rates and the company's solvency, and at the same time, low debt means a possibility for future growth. The last thing I really like about this opportunity is the potential high return on investment. In this forecast, I'm being very conservative because I assume the free cash flow for the whole year is much lower than the free cash flow of the first 9 months. In this case, I'm assuming it's 14.6 million, and here I'm assuming it's 20 million, while the free cash flow in the first 9 months is about 40.9 million. I also assumed that the outstanding shares would increase by 5%, which I doubt will happen, but I want to be very conservative. The return on investment in the first forecast is 31% if I pay the market price for the stock, and in the second one is 45% if I buy the stock for $1.61, and this high return is one of the reasons that I want to invest in this company. Now let's talk about the things that I don't like about this company. I don't like that the net income has been negative in all of the past 6 years. I don't use earnings per share to value a stock, but I know many investors will not consider a stock if the net income is negative for many years. I don't like that in 4 out of the 6 years we're examining, the free cash flow is negative. This makes me feel uncertain because of the unproven record of free cash flow achievement. But because 2023 could be a positive free cash flow, I'm taking the risk. Another thing that I don't like is the continuous increase of the outstanding shares, which is the reason that I increased the outstanding shares in the forecast earlier by 5%. I understand the reason behind the increase in 2020, which is acquiring a new company as we saw earlier in the number of customers graph, but what about the other years? I think the justification is that they had to issue new shares because their free cash flow was negative, so they needed cash for their operations. I don't like that this stock is not a dividend company, but I don't blame them because they are growing and this is not the right time to distribute part of their earnings. And with that, I did my part presenting this analysis to you, and now please do your part by leaving a comment about any part of this analysis. Thank you for watching this video to the end, and see you in another analysis video.